Okay, good afternoon, everyone, and thank you for joining the University of Queensland's webinar on the business case for behind the meter energy storage, Q1's performance of our 1.1 megawatt Tesla battery. I hope you're all doing well in these crazy times of COVID-19 and in this adjusting to our new virtual world. It's probably reflected in the positive response we received to this invitation with over 400 registrations from across Australia and internationally. So it's great to have you on board. For those of you who don't know me, I'm Professor Peta Ashworth, and I have a dual position here at the University of Queensland as Chair in Sustainable Energy Futures and Director of the Andrew Liveris Academy for Innovation and Leadership. And I'm going to be your host for the session today. Before we start, I'd like to acknowledge the traditional owners and their custodianship of the lands on which UQ operates. And on behalf of the team today, we pay our respects to their ancestors and their descendants who continue cultural and spiritual connection to country. I'd like to first of all just deal with housekeeping issues. So you'll note that you're muted and unable to share video, but don't worry, if all you can see is just us and the rest of the team and no one else, that's what's supposed to happen. We do have a Q&A function, so if you do want to ask a question at any stage, just click on the Q&A link at the bottom of your screen, and Danielle's working behind the scenes to collate them all for after the presentations. And of course, we're going to make this recording available after the session. And just before we sort of get into the presentation, I must admit, I just want to say that I'm very thrilled to be part of today. It's been a fabulous opportunity for me to work with Andrew and the team at Property and Facilities, especially around the work been doing around the Tesla battery and the Warwick solar farm, because it means, in my position, the campus becomes a living laboratory, not only for students, but also researchers. And for me in particular, the Master of Sustainable Energy students and PhD students that I supervise, provides them with real life examples of how we can transition to a low carbon electricity supply. And I think everybody is aware that in this instance, batteries and storage is going to be integral to that. So the format for today is that we'll have two speakers, Andrew Wilson, who's the Senior Manager of Energy and Sustainability at UQ, and he's also the Project Director of the 64 megawatt Warwick solar farm and a driving force behind what we're going to share today. As well, Dominic Hains, our Energy Engineering Officer, who has been integral for leading the design and implementation of the systems underpinning this work. The format is that both will speak for about 10 to 15 minutes, and then it will come back to me to host the Q&A session. So over to you, Andrew.
Thanks very much, Peter, and good afternoon, everyone. Thanks for being here. Before we get started today, I just wanted to give a very quick introduction about the University of Queensland for those of you who may not be familiar. So UQ is Queensland's oldest university. We're 110 years old this year. We've got over 50,000 students, nearly 7,000 full-time equivalent staff, and we're consistently ranked within the top 50 in the world. However, what many people don't realise about a university is that we're also a very energy intensive operation. And this comes from just the nature of the work we do in a lot of our spaces. We have physical containment research laboratories, we have -80 freezers, we have libraries, we have art galleries. So inherently with our operations comes a pretty significant energy bill. It's about $20 million each year and about 140 gigawatt hours of consumption. And every dollar we spend on our utilities bill is a dollar that we can't put towards what our core business actually is, which is teaching and research. So my team's role really is to reduce that environmental footprint, to reduce that spend, but also to look at doing it in ways that help us, I suppose, push the boundaries about what's possible in the energy space and the energy transition that we're going through as a country and a society. And that's really, I think, a great segue into the Tesla battery project, because this is a project where we've been able to accomplish all of those things in one. So some of you are probably wondering, why would a university invest $2 million in a large behind the meter battery energy storage system? This is not a battery that we're using for research purposes. We don't have it in a lab somewhere pulling it apart, studying it. It was installed predominantly for commercial and energy risk management reasons. So to understand why we would do that, I need to sort of take you on a bit of a journey about where UQ is going with its energy consumption. So At the start of this year, UQ became the first university in Australia to become a participant directly in the wholesale spot market. So what that meant is we've effectively gotten rid of our retailer as the middle person, and we no longer receive a peak and an off-peak price for the electricity we buy. And we're instead exposed to that 30-minute variable spot price in the national electricity market, or the NEM. Part of the reason for doing this is that UQ had this desire to more actively participate in the market rather than just being a sort of passive retail energy bill payer, and move towards this model that we've sort of dubbed the Jen Schumer. It's a bit of a play on words with Jen Taylor that some of you may have heard of. And what it means is that we will participate both as a large energy user or consumer, as well as a large energy generator. And where the generation side of things comes in is the Warwick Solar Farm. So this is an initiative, another world first initiative that UQ's embarked on to be the first university in the world to be 100% renewable from its own generation that we build, own and operate. So we're not a PPA off-taker for this facility. We've been involved in its development, construction, and now commissioning is about to start in a couple of weeks' time. We're about to begin our first generation to the grid. So where this leaves us is what you can see on the graph there. So during the middle of the day, that energy load we have is largely taken care of by the generation as an average across a year. Obviously, that can vary interval to interval. So our daytime position is largely taken care of, but we then have that surplus energy during the day. Now, for both the energy we have during the day, that is surplus to needs, as well as that energy we have to buy back from the grid overnight, we're exposed to the wholesale spot price. And for any of you familiar with the NEM, you'll know that that can be a very volatile market, perhaps one of the most volatile financial markets in the world. Being the kind of organization we are, we do require a degree of prudent risk management to make sure that we are not completely exposed to those volatility of the market, and we don't bankrupt the university in a couple of bad intervals in summer. So in practice, what that looks like is we implement some hedging strategies. You can see there the blue and the green. What this represents is the sorts of financial instruments that we will put in place to give us a degree of price certainty, both for that surplus solar we're selling, as well as the energy we need to buy from the grid. But it's also not a good idea to 100% hedge a risk. You'll simply end up overpaying. So what we are left with is a degree of price variability, and I suppose merchant price exposure is the correct terminology. This presents some really great opportunities for us, because what it suddenly gives us is an incentive to worry a little bit less about the quantity of energy we use, but instead to focus on the timing of when we use that energy and to try and shape our energy curve to match the underlying price dynamics of what's happening in the NEM. And this places us in a relatively unique position. And this is where the idea of needing to start looking at things like demand response comes in, and an area that we're now really heavily focused on. And the natural next step for us was to look at energy storage, which is able to take advantage of both that surplus solar energy, as well as helping us hedge the risk of our consumption, particularly in those shoulder periods that have typically been higher priced. So a couple of years back, we made the decision to sell the LGC certificates that we'd accrued from our rooftop solar over recent years. We earned about $2 million from doing that. We first time in my life I've probably ever picked the top of a market, but we effectively were able to pick the top of the LGC market, sell those certificates and put that money aside for investment in the sort of next generation of technology, which was our Tesla Power Pack system. We don't really have time in this presentation to delve into the construction and siting and technical side of things. More than happy to answer any questions of that in the Q&A section of today if you have them. So I'm going to jump in now to our performance during Q1. So as you've hopefully seen from the report, we had a very successful first quarter of operation. The battery exceeded our business case expectations and forecasts by about 20%. And that was despite the fact that we didn't have the peak demand lopping functionality enabled yet. Dom's going to talk a little bit more about that later on in the session. You can see there, though, that overperformance was largely driven by the frequency control ancillary services market. And I'll touch on that in a moment. But that significantly outperformed our expectations. And that was largely due to the events that happened in the NEM during the first quarter around bushfires in New South Wales and Victoria, as well as the separation of South Australia from the rest of the NEM later on in January. So that was a really big financial driver for us. we saw that the arbitrage revenue stream pretty well hit expectations. It was about 2% off or something like that. And then the virtual cap service, which I'll talk about soon too, also managed to exceed our expectations. So I'm just going to touch on each of those revenue streams in a little bit more detail now. So arbitrage. This is the I suppose service that a lot of people think of when they think about energy storage. So charging when prices are low and then discharging when prices are high, and trying to get the best spread between those prices that you can at all times. The graph I've got on the screen there is one that I really like, because what it shows is the cumulative revenue from that service across the quarter that we earned. And you can see that the line dips down a bit when we have to spend money charging and jumps back up again when we earn money from discharging. And what's interesting about this is that I think we, like probably many other people, had a bit of an assumption when we modeled the batteries business case that the revenue earned would be a little bit more progressive rather than the sort of big jumps that you see there, particularly during January. But certainly that's been the case. And without going into it too much, because we'll release a new report in due course, that's very much the trend we're seeing during Q2 as well. Although in that case, the big jumps are not so much being driven by high prices, but in fact, negative pricing that we're seeing occur, particularly in early May when there was some constraints on the Queensland-New South Wales interconnector. There was actually a day where we were able to earn $1,300 of revenue before we'd even discharged the battery in the evening peak, purely from picking the right intervals to charge up at. So something else about arbitrage I wanted to touch on, and it's something that I think is probably overlooked by a lot of people, is that arbitrage is not free. Putting aside the spot energy cost and revenue for a second, there are ancillary costs associated with undertaking arbitrage, whether that is as a behind the meter battery or a utility in front of the meter battery. And we looked at our energy bill and sort of deconstructed this to explore it in a bit more detail. And what we found is that when accounting for round trip efficiencies, we pay about $32 per megawatt hour in ancillary charges. So things like transmission, environmental certificates, LGCs and SCCs, and AMO market fees. Of course, that's not the final cost. We earn the large majority of that back as a saving when we discharge the battery. But because of that round trip efficiency loss, which is about 15% in our case, we found that there still is a net cost remaining for that arbitrage, and it's about $5 per megawatt hour, and that's fairly significant number, and that'll be higher and lower for different specific network charge circumstances, etc. But it's nonetheless a number that we need to be mindful of when we're looking at the minimum viable spread for arbitrage, because all of a sudden, $40 spread in the market is not necessarily a $40 spread, it may be a $35 spread. So this was a really interesting piece of analysis, and we think it's got a lot of ramifications for business cases of these kinds of assets all over the country. Contingency FCAS. So a really quick introduction for those of you not familiar. The contingency FCAS, or frequency control ancillary services market, is a service whereby we're paid by the grid operator to remain on standby to respond to sudden events in the network that cause the grid frequency to drop very suddenly and rapidly. So an example would be a transmission line tripping offline, or in the case of the example on the screen, a brown coal-fired unit in Victoria suddenly tripping offline. The cool thing about batteries, and I suppose where they're getting a lot of hype, is the ability for them to respond to these events very quickly and to change the way they're operating, faster than a human can blink their eye. And the reason I like this example is because it shows exactly that. So on this particular afternoon, we were charging at about 900 kilowatts for arbitrage reasons. We were getting ready ahead of a forecast price spike, and then all of a sudden that event happened, and the battery was able to not only start fully discharging, but to swing between those two modes very fast and provide actually 2 megawatts worth of support to the network, even though the rated capacity of the battery is only 1 megawatt. So this is an area where I think we're going to see a big explosion of batteries participating, both because at the moment it probably is the most valuable revenue stream that batteries have access to, as you've seen from our results, but also because they're just uniquely technically suited. And we're really looking forward to potentially participating in things like a fast frequency response market or a virtual inertia style of market as these develop over the next couple of years. Virtual cap contract. This is a relatively novel concept that we developed and I suppose looked at when we were putting the business case for our battery together. As I said earlier, UQ is exposed to the spot market price, and with that there's a degree of risk that we need to prudently manage. One way that that can traditionally be handled is buying something called a cap contract. And now a cap contract functions a little bit like an insurance policy. So you pay a premium and in exchange you receive a payout or revenue if certain events occur. In this case, it's usually the incidence of prices above $300 per megawatt hour. We looked at it and said, well, we pay all this money to a counterparty to provide this financial insurance for us. Could we do the same thing by using the battery to effectively discharge energy during those price spikes so that we could then reduce our exposure and then avoid paying the premium associated with the financial cap? And what we found is that across the quarter, I suppose we had mixed performance overall, as you can see from that graph there, but overall we were really happy with how that performed. So that graph you're looking at represents the percentage of coverage of our exposure in each of the 18 intervals that exceeded $300 per megawatt hour across Q1. You can see there we had some intervals where we had nearly perfect coverage. We had some that was, sort of in between, and this is largely a function of the 5 and 30 settlement dynamics of the NEM. And we had a couple of shockers, that in particular, the 23rd of January and the 31st of January. Particularly looking at 31 Jan, you can see there that not only did we not discharge the battery to cover our position, we actually charged the battery. So we increased our exposure beyond 100% of what it would have been. So Dom's going to talk a little bit more about why that happened and what led to that. But I suppose it's just interesting to compare some of the challenges of this. But we wanted to then benchmark and say, okay, well, we had these problems. Did others have these problems as well? And what we were able to do is compare ourselves to Wivenhoe pumped storage, which is the other sort of large scale energy generation asset in Queensland. And what we found is that their coverage percentage was in the sort of mid 70s. So this is with a long duration storage asset and an expert trading team manually monitoring and trading that asset as opposed to our algorithmic trading. So we were in the mid 50s overall across the quarter. But what we found is if we take out those two bad intervals where, the control system went rogue, for want of a better word, we actually were able to effectively match Wivenhoe's performance in providing cap coverage. So this is a really exciting area for us that we're going to be working on further. And Dom's going to talk a little bit more about some of the control strategy stuff behind that a bit later in the presentation. Okay, final slide from me, peak demand lopping. As I mentioned earlier, it's not a service that we had functional for the start of Q1 for various reasons. But what we found though is that as well as not giving us revenue or not earning us revenue, it also caused us some problems by not having this functionality enabled. And the example that we've got on the screen there shows that. It's the 20th and 21st of January where on the right there in the purple dashed line, that was our underlying site demand with the battery. And you can see that we inadvertently charged the battery in one of our highest demand intervals of the month when we really probably shouldn't have because we were going to incur high demand charges. Instead of the demand for the month being the number on the left, which happened the day before, we ended up having a demand about 1,000 kVA higher than that figure. And it cost us about $3,500. So this was a really expensive lesson, I suppose, in the importance of needing to co-optimize arbitrage and other functions of the battery with looking at what that campus demand is and forecasting what that campus demand is. But again, Dom's going to talk a little bit more about that later on. And I might hand over to him to talk a little bit about how we control the battery and the work we're doing in that space. So over to you, Dom.
Thank you, Andrew. Let me just share my screen. Here we go. Is that all good? Yep. Okay, so quickly, the demand response engine or DRE, what is this? Well, basically, it's a predictive control framework and it facilitates the smart operation of energy assets across our UQ sites. Our demand response engine sits in a cloud-hosted environment. For us, that's Amazon Web Services. And where this system sits is basically at the SCADA or supervisory level of a typical OSI model. So the important part to take home from this is that field controllers at the energy asset themselves are still critical to ensure the safe and compliant operation of these assets. one of the big debates that was had when designing this system was the version having an in-house solution versus an enterprise system. And I think the key driver for how we came to that decision was by looking at the specific needs of a university. So being a university, it came to three main criteria. Firstly, data transparency. So being a pretty novel and developing project, we want to be able to share the results of this project easily with staff, with researchers, and also with wider industry. Secondly, we want to be able to facilitate the ongoing enhancement of the algorithms and of the models that we've developed in this platform. And thirdly, we want to be able to easily expand this system. So in the future, we're able to expand these control policies to other energy assets across our campus. So let me run you through the aspects of the system. Let me grab a pointer. So first of all, you can see that data coming into the system, collection is obviously a really important factor. We collect data from two different categories, I guess. So we collect data from field devices around the university. For the battery, this includes information such as site metering, metering at the battery itself, and also metrics to do with the battery's operation. So what its state of charge is, what its limits are with charging and discharging, yeah, et cetera, et cetera. We also collect third-party service data. Two that come to mind immediately are data fed from the national electricity market. This includes dispatch prices across the NEM, and also the forecast streams that are released by AEMO, and that's on a 5-minute and a 30-minute resolution. We also collect data from the Bureau of Meteorology as gridded weather forecasts. Whilst not in operation at the moment, these will be critical to underpinning some of the demand forecasting plans we have for the future. So I won't dwell on data standardization, but essentially because this is a data-driven control framework, we need to be able to have data that is of high quality and that can be used as valid input to our decision engine. Data analysis, we want to be able to enrich the data that we collect from across the university and third parties. So that may be developing virtual metrics, like for instance, the real-time efficiency of the battery. Or we may want to feed some of these metrics into our own forecast models. And finally, we get to the data evaluation stage, and this is kind of where all the magic happens. So essentially what the data evaluation system is, it's a big optimization problem. I might just run through the battery, for example. What it does is it uses data coming in as triggers. So in the case of the battery, because it's a market-driven controller, we will use new information coming from NEM as the trigger for the system. It will feed into a big constrained optimization problem. Those constraints are basically to do with the physical constraints of the battery itself, like its state of charge, its efficiency, and also to do with its operational constraints. So we have a commitment of having 10 minutes of capacity left for FCAS services, for example. The output of this service is a policy, which is then delivered back to the field controller or the battery controller. And you can see that the whole system itself is a cycle. So when new data arrives, the whole process repeats and a new policy is created. To those of you who are control proficient, you would pretty much identify this as a model predictive control approach. So I might just run you through an example today to have a better idea of how the battery works in operation. So this is the performance of the battery on the 4th of January, 2020. As you can see from the gray trend here, we have the spot market price, the energy market price, sorry. You can see that the morning and early afternoon peaks were categorized by relatively mild prices with quite a significant amount of volatility occurring in the afternoon. At 6:30 a.m., you can see that the battery charged up, although not at its rated capacity. It would have done this because the forecasts it was currently seeing at this time did not show the volatility that has eventuated overall. It wasn't until 1 o'clock or 2 o'clock that the volatility in the market started to appear. And you can see that the battery charges itself up at $52 a megawatt hour. And this allows it to appropriately respond to the first price spike, which was $2,000 per megawatt hour price. You can see at 4:30 that the battery again sees a small trough in the spot market and finds it an ideal time to quickly charge up the battery a little bit more, and is then able to respond to a $334 per megawatt hour price spike. Moving later into the evening, you can now see a bit of a reason why inaccurate forecasting coming from the NEM can mislead the operation of the battery. So the most obvious example here is that at 7:30 p.m., we had a $245 per megawatt hour price spike that the battery charged through. And the reason it would have done this is that it would have seen a forecast further in the future for high pricing that obviously never eventuated. A better way for me to run through just how imperfect forecasts can affect the operation is shown on this slide. So I've used the 31st of January because it was characterized by distinctly erratic behaviors in the forecasts released. So reading down the screen, you can see a time series, and this is the forecast, the times into the future. You can see the spot price forecast that was generated at this specific snapshot in time, and also the policy that the demand response engine created for the battery to perform. Reading left to right, I will fill through snapshots in time, and you can see how the operation of the battery progressed. You can also see on the right-hand side that the actual resulting price in the NEM and also the resultant output of the battery can be seen. So you can see that at 11 and 12:30 p.m., there wasn't much volatility in the NEM. The DRE planned to do nothing with the battery as there was no arbitrage opportunity. One thing to point out is that we actually did manage to charge the battery at 12 p.m., almost at its rated capacity. And what this indicates is that somewhere between 11 a.m. and 12:30 p.m., volatility in the market must have been observed, and the DRE found it an opportune time to charge up the battery through that 12 p.m. interval. So stepping to 2 p.m., we can now see a little bit more of what the DRE is planning to do with the battery. You can see that the battery is almost fully charged, and we can now see a pretty clear price spike appearing in the afternoon period. So you can see that the battery is currently planning to discharge through that period. All looks fairly standard for a normal day in the NEM. What happens at 3:30 p.m.? I might just run through the fact that over on the right-hand side, we can see that there was a period at 2:30 where the battery actually discharged itself at $117. The reason it would have done this is obviously similar to what happened at 12:30 p.m. The forecast basically softened and the volatility fell away from the forecast. So the DRE thought, hey, this is the best opportunity I'm going to get to make some money. This does come back to bite the system a little bit later on in the day. Looking at the forecast at 3:30 p.m., you can see that the afternoon price peak is now much more volatile. Prices range up to $1,400 a megawatt hour. So the battery's number one priority is to recharge the battery in preparation for this spike. What actually happens with the operation of the battery by 5 p.m. is that we have already seen a price spike in the NEM. And what that's done to the battery is, whilst we were able to respond to this event with almost our rated capacity, we're now very low on capacity for the rest of the afternoon. You can see in the 5 o'clock price forecast that the spot price in the current trading interval is $94 a megawatt hour, and the preceding interval is going to spike again. So the battery thinks the DRE thinks it's a good idea to charge the battery and then discharge it again in the following half hour. What ends up happening is that price spike ends up falling in the 5 o'clock trading period as opposed to the 5:30 trading period. What this would have done with the battery is we would have been charging at almost rated capacity for the first part of the interval. Once these extreme prices were seen, midway through the 30-minute interval, the battery would have reverted back to discharging, which is why you don't see the rated output of charge as our resultant. You can still see that the battery did have a net effect of charging over that trading period. I won't dwell too much more on the rest of this slide, but basically once in a volatile part of the day, the battery tries to, or the DRE tries to schedule the battery such that it reacts quicker to prices and doesn't necessarily consider forecasts in the future as much. So I think it's important to note from this analysis that combating forecast uncertainty is critical in the success of a system like this. And one of the easy ways that we've been able to combat these issues is by implementing some rule-based controls, which supplement the forecast-driven modeling that we're using. And particular reasons why we would do this is to mitigate risk. This example that I brought up here is a scenario where the battery, as shown in the blue line, is at its minimum rated capacity, subject to the fact that we need to give 10 minutes of FCAS should an event occur in the NEM. Let's, for the sake of this exercise, say that the spot price ranges are mild throughout the day, and you can see that there's a distinct peak in the afternoon. Let's assume also that throughout this early morning and afternoon region, the forecast did not show this peak occurring. So what the DRE would do without any hybrid controls is it would not see any arbitrage opportunity all through the early morning, all through the early afternoon, and would not do anything with the operation of the battery until it was almost too late to do anything about it. So as you can see here, it was able to quickly charge at roughly 400 kilowatts and then was only able to empty that 400 kilowatts. You can also note that the prices it charged and discharged at are not optimal. The way that trickle charge works, or the method we've introduced, is where there is no opportunity to perform arbitrage through the forecast-driven controls, we're able to say, we're able to use some benchmark prices. So in this case, I've used $35 per megawatt hour as a seasonally low price. And what that means is it may not be the cheapest price in the day, but it will be an opportune period to charge if there's no other opportunity seen. And that's particularly important because of the fact that the battery is currently empty. So in the early morning, you can see that the trickle charge control drives the battery's capacity up. How much it drives it up is also another hyperparameter we set. We've chosen to be able to give us enough coverage for one full trading period if a price spike, as you can see on the right-hand side, does occur in the NEM. You can see that from this policy, we're able to get the full 1.1 megawatts out the door when that peak occurs. So, okay, so I've probably gone a little bit over, but we need to get to questions. So we've had a lot of learnings through this quarter, but we've also got quite a few features benchmarked in the next couple of quarters. The big one for us, as Andrew pointed out, is integrating demand forecasting. That is critical to being able to co-optimize our arbitrage revenue stream, but also our peak demand charge revenue streams. And on the same topic of forecasting, we also want to be able to improve the price forecasts that we're seeing, not just taking AEMO's forecasts as they are, but being able to enrich them. And we have some additional ways that we're planning on using other data from AEMO and also some of our internal data to enhance this data and make better decisions about what the actual peaks in the day are going to be. Finally, the DRE is being planned because of its success with the Tesla battery. We're planning the DRE to be rolled out to a number of other assets across the campus. That includes HVAC infrastructure. You can see on the right-hand side, that's our brand new central energy plant, which acts as basically a thermal battery. All of these assets, they basically are going to run with the same sort of optimization problem in reducing UQ's energy charges. The big difference here is that the physical systems themselves are very different and will have different constraints that we'll need to deal with. I think that's all from me though. So I might hand back to Peter and we might start Q&A.
You'll stop sharing? Yep.
Yep.
Perfect. Thank you. Very informative from both Andrew and Dom, and there's been a pile of questions coming through. So we probably won't get to feed them all, but we'll try and follow up afterwards. But I'm going to field the first one to you, Andrew. Can you talk a little bit about the battery supply cost? Do you think it's considered high or consistent with Australian prices? And someone quoted Bloomberg quotes $156 per kilowatt hour USD.
Yeah, thanks, Peter. It's a great question, and it was one reason we were really keen to be transparent about the cost of our project, because there's a lot of talk in the industry about, in the sector about what these projects cost, and we wanted to just transparently look at that. So those figures from BNEF are often, I think, not necessarily an integrated whole of system cost landed to site. So the cost we paid, which is about $750 per kilowatt hour Australian, at the time was the fully integrated system, power packs, inverters, control system delivered to the site. So I think it probably is a little bit higher than you would be able to do the project for today. I think that as the market is maturing, there is some sharpness of pricing. That being said, it's highly subjective to the AUD USD exchange rate. So I think perhaps some of those other savings might have been eaten up in Australian dollars by the fall in the AUD recently. But more importantly, I suppose you need to look at what the other costs of installing the project are, more than just the cells and the inverters. And in our case, there was about another $200 per kilowatt hour of costs associated with the civil works, so the clearing the site, putting the slab in place, the balance of plant, so the electrical metering, switchboards, cabling, etc., the commissioning, and as well as some of the soft costs, the consultancy work we needed to get our connection agreement updated, and our scope of works and specifications written, etc. So we break that down transparently in the report. But I think it's probably, I mean, we ran a competitive process and we a tender process to get that result. So we did benchmark that across multiple players, and they were relatively close to one another. So I think the price is pretty close to the money, but you probably could do it slightly cheaper in terms of the supply cost of the battery. But that being said, the big variable factor is going to be those site prep works.
Thanks, Andrew. There's a guitarist just starting up, so hopefully that might come in as background noise for the webinar. But there's another question for you, Andrew, from Carl. Your FCAS revenues are excellent. Do you believe this is sustainable, or do you expect there to be a downturn in the medium term?
Yeah, that's a great question. It's one a few people have raised. As you saw, I mean, the revenues outperformed our expectations by 50% as it was. So we certainly don't expect that performance to be repeated every quarter. And in fact, we're not seeing FCAS pricing at that level during Q2. I do believe there will, in general, be a softening of FCAS prices over the next few years. It's a relatively shallow market, and as more players come into it, that will inherently just dry up those revenues or suppress those revenues. That being said, though, there is dynamics happening within the NEM where some of those more traditional players that provided those services, are expected to withdraw over the sort of medium-term horizon. So that will provide some support to a sort of base level of pricing. But we're also looking at beyond the FCAS we do just today. So I don't think that contingency FCAS will be our main revenue stream in 5 or 10 years from now. I anticipate it will be some other combination of FCAS or grid support services as we transition away from synchronous generators to asynchronous renewable energy plant. And we need some of those services for grid support that we traditionally get from those synchronous generators. So whilst maybe we've called it FCAS today, I expect that avenue of what the battery can provide to the market will remain valuable in one form or another throughout its life.
Thanks. Okay, next question over to you, Dom, from Igor. Real cost of arbitrage should also include depreciation of battery due to degradation. Have you included this in your cost structure?
Yeah, definitely. So the way that the optimization algorithm runs is we inbuild that differential cost into our optimization. So when every time the new forecasts are received and the battery is being reevaluated, that cost is taken into account, which is why a lot of the time when you see a mild forecast, the battery will choose to not do anything, even though there is some up and down in the forecast.
Okay, and there's another one for you, Dom, from David. Are you connected to 22 kV or 66 kV lines in the network? And can you tell us a little bit more about the connection?
So UQ has a HV ring main that's at 11 kV. In terms of the connection to that HV ring, we don't necessarily need to worry too much about what's beyond our incomers. Because we're in a nil export arrangement with Energex. So we maintain our HV network at 11 kV, and that's what the battery operates on.
Perfect. And Andrew, from Oliver, the report finds the virtual cap will perform best when prices spike less frequently than forecast. However, this is counters the interests of battery arbitrage, which favours price spikes and volatility. Have you assessed if volatility is more or less favourable?
That's a brilliant question. Thanks for that, Oliver. Yeah, it is an interesting point. I would probably slightly rephrase it and say that the virtual cap service, as it's represented to us, is also a reflection of the price you could buy the cap contracts for in the market. And in our case, we considered what we could have purchased this for in the 3 months preceding the start of the quarter. So it's also a reflection of that sentiment and whether or not caps are being sold at a high price or a low price. But yeah, obviously, if the volatility levels are lower than what the market was expecting and the price you paid for that product, that's going to be more lucrative for the service. So I think volatility on the whole is a good thing, but in different ways. So in Q1, as you saw from our results, volatility being lower was good because, as you saw, arbitrage, virtual cap contract was worth nearly twice what arbitrage was to us as a function of that dynamic. However, in other quarters, like Q2, when we're in now, cap prices have historically not been that high, and they weren't that high this quarter. So that revenue stream will not be as large. However, we actually expect that arbitrage revenue stream to be bigger, not necessarily because of those high prices, like I said, but actually more opportunities to charge up at a lower price and actually get a wider average spread per day. That being said, obviously, those who follow the NEM closely will know that there's this rather strange dynamics happening in the market at the moment with the impacts of COVID and lower gas prices and increased gas generation, particularly in Queensland. But we still see in quarters outside of Q1 that arbitrage being a more valuable service to us. But in Q1, I think it's the inverse, and we see that virtual cap contract service being more valuable to us there. So yeah, I hope that answers the question, but highly complex area that is going to be very interesting. And one of those ones I think you can forecast until the cows come home, but ultimately you just need some lived experience of trying to operate and co-optimize those services to figure out what's going to work best for you.
Hence why it's good having it at the university, so we can live and learn, I suppose. Dom, there's a question from Lee about, is the battery in a controlled temperature environment? Obviously, different batteries have different sensitivities. Can you answer that for us, please?
So no cooling or no HVAC is done external to what Tesla provides us. So the power packs come as is, it's in an outdoor environment, and all the temperature control is done under the hood, basically in Tesla's SMC or Site Master Controller. I don't know whether Andrew wants to add anything to that, but.
No, I think that except to say that I didn't talk about construction in the presentation, but that was a really interesting area of the project, and the modular nature of the power pack system was one of the draw cards to us. If you've seen the photos in the report, it was quite a unique space, and we actually had a lot of challenges finding a spot for this on campus that avoided flooding, but was also close enough to enough transformer capacity to enable us to connect into both charge and discharge. So that modular nature was key. And what we found is a lot of other lithium offerings out there, they are in a sort of controlled temperature unit, often in a shipping container and often in 40-foot shipping containers. So both aesthetically and sort of ability to be dynamic with how we placed that and configured that, the modular nature of those self-contained power packs was really appealing to us.
Okay, Dom, given AEMO imperfect forecasts, to what extent have you contemplated generating your own NEM price forecasts?
To a great extent, in short. There is definitely opportunity to enrich what AEMO gives us. And we have the ability to, much like how we are trying to build our own forecasts of demand for the campus, we can also use historic forecasts to try and find patterns in just how forecasts were seen and then what actually eventuated across the day. It's obviously a complex one. There's a huge amount of parallels between any market and say the stock market. So there's definitely no easy solution to this problem, but we're definitely on the track of making some more decisions about how we can particularly deal with the problem of forecasts falling away. And being able to take advantage of prices that have a more likely outcome of coming off, rather than prices that are shown towards the end of the day, for instance, that typically tend to fall away by the time we get there.
And let's build on that. From Mark, what difference would 5-minute settlement make to your bidding strategy?
So good question. In terms of the bidding strategy, on a 5-minute basis, we'll be able to react immediately to, I guess, what we see at the current time. I guess the side effect of going to 5-minute pricing is that I think there will be a significant increase in volatility of those forecasts, is probably the way I would see things going. I think the first couple of years of 5-minute pricing is probably going to have a lot of potential opportunity for assets such as a battery to take advantage of these changes in price. But in terms of the control optimization problem, we're able to deal with 5-minute pricing in largely the same way. The forecast is basically what we use as our input, and if the forecast has its uncertainties, then that's something that we have to wear in our modeling.
Maybe I'll just add to that as well. The thing about 5-minute forecasting is it makes everything we're doing with DRE more important in terms of the speed of that response. Because at the moment, if DRE has to consider new input data and it takes 1 minute to do that, that's not so important in a 30-minute interval, but 1 minute out of 5 is a really significant amount of time. So that speed of data processing, that speed of data retrieval becomes absolutely key. And that's an area where at the moment, where we've got a lot of room for improvement, and particularly once we connect directly as a participant to AEMO through the Warwick Solar Farm, and we're not relying on the public NEMWeb data, which is a little bit slower and more unreliable. So that speed of response in 5-minute market will be absolutely key.
Okay, here's another interesting question. Someone said, interesting that the battery default seems to be stay empty unless reason to charge. So Dom, I'm going to suggest this for you. Rather than charging overnight by default, is it deliberate to keep it available for negative pricing?
So, I mean, the battery will run itself flat, and well, not flat, but it'll keep its minimum requirements for FCAS. At the time that the battery recharges itself, it's doing so because it sees opportunity to make value out of that energy that it's charging back up. Like I pointed out with that trickle charge control, if there is no market volatility being observed, that mechanism gives us the ability to fill up the battery at prices which we deem as relatively good for the quarter. And that's our financial, I guess, risk mitigation strategy there. So it's not that we want the battery to remain flat most of the time, and I wouldn't expect the battery to remain that flat all the time. Andrew, do you have any other thoughts on?
Yeah, it goes to, there was many hours of robust discussion amongst the team in the office about the best way to actually configure arbitrage, whether it's retrospective or prospectively. So without getting into the weeds, that's saying, in order to do something, we need a minimum spread between the charge price and the discharge price, or else, because of all those reasons we've talked about, degradation, ancillary costs, it's simply not worth doing it. But how do we reference what that price is? Do we reference what the price is in the future or the past? So is it the price that we last filled the battery up for? Is that the reference price for the arbitrage calculation? Or is it the price we can recharge the battery at in the future? And both methods have pros and cons. And we ultimately decided that a prospective approach was the one that would result in the least inadvertent outcomes. So what that means is that if the battery is seeing $150 per megawatt hour, it will only discharge in that $150 per megawatt hour if it can charge up again cheaper the next day and at a level that exceeds our spread. But I don't want to get too far into the weeds on that one, but it's a complex area, thinking about how we actually optimize the decision about when to charge and when to discharge, because there are various variables involved.
Okay, so next one is for you, Andrew, from John. So historically, the concept of water treatment, waste management and energy generation has been seen outside core business of higher education. Do you believe that your achievements, what we're seeing now, suggests it needs to be core business in the future?
That's a great question. I'll start by saying I'm not sure I've got the energy left to take on waste treatment and water treatment as well as energy generation. But yeah, I think we're really passionate about leading in this space, and I don't see it as not being core business. There's two parts to that. leadership and pushing the envelope and demonstrating things that maybe the private sector would be reluctant to do is the core business of the university. If we're not going to do it, who is going to do it? So I'm very much a believer that we should be pushing the envelope on those things. And secondly, what I'll say is that between energy, water and waste, we spend $30 million per year on utilities. That's a big chunk of change in anyone's book. So proactively managing that spend and making sure that we're not spending $1 more than we need to on something that, quite frankly, is not very exciting and doesn't actually further the interests of the organization, that should be our core business, to make sure we're operating efficiently. So yes, we probably are like pushing the envelope quite aggressively in terms of playing in that space, but I think it's highly compatible with what we're set up as an organization to do.
It's definitely great from a research perspective. I can add to that. So Dom, are you incorporating machine learning into DRE?
I love this word. So yes, we are planning on using machine learning in our demand forecasting. Is probably the best place to point that out. So the way that that's going to evolve is we have, as I said, we collect data from the Bureau of Meteorology. We also have all of the historic data that we have in relation to the battery, but more importantly about the campus as a whole. So yeah, in a short sense, we will be using machine learning techniques. More specifically, we'll be looking at time series forecasting and particularly the neural network side of things. If we want to go into that much detail, I'm not sure.
Gives us an indication. Thanks, Dom. Andrew, did virtual cap contracts replace all cap contracts, or was there a residual risk that needed to be mitigated?
Great question. No, they didn't. Partly because our peak demand in summer at the St. Lucia campus is about 27 megawatts, and the battery is only 1 megawatt. So we'd still be left with 26 megawatts of exposure. That graph I showed earlier in the presentation with those hedging in the blue and the green, that was a very simplistic representation. Working with our consultant partners, we put in place a hedging strategy, and effectively a book build is the terminology in the industry, to hedge that risk. So we used a combination of flat swap contracts, peak swap contracts, and traditional cap contracts to build that hedging position. But as you saw from that graph, there was the residual degree of spot price exposure remaining. What the battery cap contract is doing, is enabling us to do, is it is enabling us to increase that amount of residual spot price exposure. So put very simply, maybe we ordinarily would have hedged 80% of our risk with financial hedging products. By using the batteries 1 megawatt, we only had to purchase or build 70% worth of our risk with financial products, and the battery was able to fulfill that extra bit. And then as we add more and more of our demand response assets in an autonomous manner through the DRE system, we'll be able to reduce our reliance on those financial hedging products even further. So that's a really exciting area for us. I think we will always have some degree of financial hedging, but we certainly expect it to be a lot less than it is today once we get more comfortable with using our assets in this way.
So we've got about 5 minutes, so probably a couple more questions. Andrew, what are your data sharing plans in the future for this project?
Thanks, Peter. That's a good question. So we published this report because we wanted to be really transparent, and we know that this is an area of interest. You know, the fact we've had hundreds of people on this webinar today, it just goes to show I think there's a lot of interest in these learnings, and we want to share them as widely as possible. So we're probably not going to do quarterly reports. It was a lot of work to put that together, and on top of our sort of day jobs that we've got going on at the moment, we probably will publish our performance reports annually. But also one of the unique features is we've got a website which shows the battery's real-time performance. It's a dashboard. You can find that by just typing UQ Tesla dashboard into Google. It'll pop up as the first result. But on that dashboard, if you go down to the bottom right-hand corner, there's a Get Data button. And that enables you to download the battery's performance data. So it's power, set points, pricing, et cetera, et cetera. It actually now allows you to download it on either 1 minute resolution or 4-second resolution. So the 4-second resolution is really good for looking at things like FCAS response and frequency events. So we intend to make that data fully, publicly, freely available to people. So yeah, check out the website if you're after that high-res data.
I'm sure a couple of eyes lit up when they heard that. Andrew or Dom, do you believe that adding storage would add value in being able to respond to more pricing events?
I'm happy to take that one. The short answer is yes. I think we saw this particularly when we looked at the performance of the virtual cap service, is that those times when our coverage percentages were lower were often driven by the fact that the battery simply didn't have enough in the tank left to respond. And although that being said, you know, Wivenhoe, who did have more, didn't perform that much better. So it would definitely help. The cool thing about the power pack system is it's highly modular, and you can literally plug more storage in, and you actually don't need to change the electrical configuration. You can keep the same inverters, same connection, everything, and you literally just plug more storage into it. So it's not on our immediate plans horizon. We think that sort of that 2-hour duration at full discharge is working pretty well for us, but I suspect a lot of other people have done work on this, and that sweet spot of storage versus power is probably somewhere in the 2 to 4 hour range. That being said, once we move to a 5-minute settlement world, it's quite possible that will shorten up, and that sweet spot might only be in the 1 hour to 2 hour range. But you really need to delve into the cost build of what that system's worth in terms of the battery packs versus the inverters plus versus the balance of plant, etc., to look at those trade-offs. But not in our immediate plans, but I do think it would help, at least marginally.
Okay, one final $1 million question, Andrew. What would you do differently?
That's a great question. I hate to say nothing, because we're not perfect, but you know, this is a project that overall has been very successful for us, certainly from the installation side of things. As I mentioned earlier, we had some trouble finding a location. It actually took me 3 times as long to find a location that everyone was happy with than it did to get the funding approved, which is a pretty extraordinary statistic. So I think understanding how to physically site these things is really key, and that would have saved us a fair bit of time. In terms of the control algorithms, I think we've been fairly transparent with what the downfalls are. I wouldn't do anything differently per se. I think I'm happy with how it performed in Q1. But what we will do is we'll build on those learnings and implement some of those things that Dom talked about to really take things to the next level. So I think for a first quarter, we really couldn't have asked for more. But that being said, we know that this is a really exciting space, that there's a lot more to play in the future.
Perfect. And I think that really just about brings us up to the hour. So thank you, Andrew and Dom, for sharing your wisdom, and also to all of the participants and their questions. It's very exciting. Obviously, we will share the information back, the link to this, and also I think we'll find a way to collate some of the answers to all the questions we didn't get to. So a virtual round of applause for our presenters, and thank you very much, participants. Have a lovely Friday afternoon and stay safe in these COVID times. Thank you.
Thank you, everyone.
Thanks.
Thank you.